Wall Street Week with Louis Rukeyser is made possible by the financial support of viewers like you. By The Travelers, the company that helps provide financial peace of mind for over 40 million Americans. And by Prudential Bache Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, January 5. Our panelists are Howard P. Colhoun, John Dessauer, and Carter Randall. Tonight's special guest is Peter Lynch, Director, Fidelity Management and Research Company.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, I don't know what happened to all those drugs Manuel Noriega is alleged to have been sending into the United States, but the stock market sure looked like it was on something weird this week. It began the year with a super high, right on up to a new all-time record above 2810 in the Dow Jones Industrials, thereby sending a whole new crew of gloomy gurus out looking for aspirin. But then came a series of downers, 3 straight losing days, ending in a manic sell-off in the stock index futures market. And along the way, there were enough hysterical reversals in both directions to keep a regiment of therapists and a battalion of pharmacists busy from dawn to dusk. Where are those alleged institutional investors actually smoking these days, anyhow? It was, on balance, a pretty good week for the world, highlighted by a memorable double act featuring the White House and the Vatican Embassy that caused General Noriega to check out considerably earlier than he had planned and for a different destination. The result surprised all those folks who, having continued to misread the lessons of Vietnam, have argued heatedly that the U.S. could never successfully use its power anywhere. And wasn't it nice for a change to see a foreign population cheering U.S. troops again? How it will all play out in the future remains to be seen, but for the moment, George Bush, who hasn't yet officially announced his candidacy for re-election, is smilingly awaiting the opportunity to throw his Panama hat into the ring. Not so euphoric is Mikhail Gorbachev, and that was one of the market's depressive pills as the week ended. Gorby, whose canonization in the Western media may turn out to have been embarrassingly premature, postponed all meetings with foreign leaders to concentrate on the Soviet Union's whopping domestic problems, a decision that fueled speculation that he might now have a better future in Manhattan than in Moscow. The peacemongers of Wall Street didn't like that development, nor were they enthusiastic about a string of late-week economic reports that, taken together, seemed to indicate an economy that was too weak to start another boom, but not weak enough to call for rapid lowering of interest rates. And so the bond market fretted and declined, the dollar weakened, notably against the West German mark, which is expected to be the big beneficiary of the Iron Curtain's meltdown, and the general jitteriness even offered some mild relief to gold and silver. The stock market's manic week was, as usual, exacerbated by the absolute nuttiness of the institutional computer games, notably and perhaps more clearly than ever before, by the villainous, and let it be said, insufficiently maligned program trading. Talk about your seductive narcotics. But the week was not without its amusing footnotes, notably the fastest burial of a would-be super pessimist in the history of gurudom. An odd fellow who calls himself P.Q. Wall, though his mother didn't, got miles of space in the more hysterical precincts of the financial press this past October when he announced authoritatively that it would be 20 years before the Dow ever again got as high as it was then. Sure was scary, and sure was silly, as the market promptly demonstrated by throwing him into that long, long line of discredited, gloomy gurus in less than 3 calendar months. Why, for once, we didn't even have time to put him on the air and expose him before the market did the job for us. Tonight, we're going to move from the ridiculous to the sublime and talk with a modest man who, unlike the long string of over-publicized flashes in the pan, actually does have heaps of valuable advice for the average investor. Peter Lynch, the single best public investor of the past decade. But first, let's pay a call on the addicts of Wall Street. The Dow began with a bang, a new high of 2810.15, and on impressive market breadth and strength, but then quickly began whimpering. Tuesday's 57-point New Year's explosion was enough to keep the Dow ahead for the week, but the net gain eroded to just over 20 points as the Dow closed at 2773.25. Down the line, the results were mixed. The New York and S&P composites actually declined, but the secondary issues on the Amex and the over-the-counter market came on strong, as they often do in January. As for our chief elves, 10 analysts who rate the market's technical prospects over the next 3 to 6 months, they lost 1 vote as Ned Davis switched from bullish to neutral. The net reading of +2 is now only mildly bullish and the lowest in 5 weeks. And if all this nervousness drives you to drink, keep in mind that a survey in Bartenders magazine found that the worst tippers were doctors, while the best were other bartenders. I guess the doctors figure they gave at the office. Americans of all descriptions are growing more numerous. The Census Bureau reported that we began the year with just under 250 million Americans, and will add another 2.5 million by next New Year's Eve, or roughly the population of Kansas. Gosh, Toto, it does look strange around here. Colorado, what do you make of this wild and woolly start to the year?
I don't think it's a surprise. First of all, there was an awful lot of money pent up waiting to get into the market, and it sure went in on that first day. There's no question about that. But I think more sober thoughts have been that maybe this is not going to be the greatest economic year in the world's history, and so there's been some selling. As far as I'm concerned, I'm not pessimistic, Lou, but I do think it's going to be a year of caution, and I think there's going to be a lot of disappointment in corporate earnings as the year goes on. And if those interest rates don't come down by much, it could be a negative economic year.
You've been leading us to think that we might have interest rates coming down. The bond market seems to be unsure at this point.
I've been expecting a decrease in the prime rate now for weeks, and it hasn't happened, so have a lot of other people. And
why is that? The bankers just trying to build up their profits?
Oh, I don't think so.
Heaven forfend.
I think it's a wait and see sort of thing as to whether there's going to be a demand for money or not. I still think we'll see rates come down, but whether they come down enough to spur the economy is a big question.
One last question on that, Carter, because you were a banker for many years.
Yes.
Did you ever notice that the prime rate seems to go up faster than it comes down?
Well, sure, but I wonder why.
John Dessauer, you have been our guide to developments all over the world. This is a week in which we've focused on Eastern Europe and some of the other parts of the world. How is it going to affect the financial markets of the world, the things we saw this week?
Well, I think it's going to affect them positively. Looking back over the last year, if a year ago someone had predicted what actually happened, that German interest rates would go up from 5.5% to 8.5%, you never would have guessed, that there would have been any hope for the German stock market under those circumstances, but it finished the year up 37%. Not bad when you're fighting uphill against interest rates. Further, we never would have expected that interest rates in this country could have come down under those circumstances, but our rates did come down, and surprise, surprise, the dollar really didn't collapse at all. So we got through 89 actually in pretty good shape. Now in 1990 they're telling us that economic growth in Germany in particular could be somewhat better than expected. With the dollar down a bit from its peak against the German mark, that could mean that 1990 could be a somewhat better year for America too, as we export more goods to Europe.
Let me go back to the first point you made, because it's a fascinating one. We keep hearing this is an interdependent world, that all these economies are interrelated, that we can't do things on our own. How can the West Germans push their rates higher? How can the Japanese push their rates higher and U.S. rates come down?
It's interesting that in 1989 we saw some separation of these 7 major world economies, and a good thing too. But really gets the economies of the world and the financial markets into serious trouble is when everybody goes to a boom together and then you get a bust together. But fortunately, the central bankers managed to prevent the boom together, and in 89 started to go more their separate ways, and I think we'll see more of that in 1990, but there are limits. I don't think we'll see interest rates in Germany of 3% this year, and that means there could be more latitude for interest rates to come down in the United States in 1990.
Pete Calhoun, what's the key to the next few days? The first day of the year or the next 3?
I think the next 3. I think we should reduce our expectations for 1990 because we really, in 1989, when the market was up about 30%, we borrowed, I think, some good results and took them out of 90. I might also note that the decade of the 80s and the decade of the 50s were fantastic for stocks, up about 18% a year, where the long 62-year experience is 10% a year. I don't think the 90s will be anything like the 80s in terms of results of financial assets. The first year of every decade, 7 out of 10 of the first year of the decades, has been a poor one. And I think we should have reduced expectations for 1990. The 3 areas that I like are emerging growth, oil service, and technology.
Let me ask you a specific question. You say oil services. Is that tied to what you expect for the price of oil?
I think oil will go up. Oil stocks will do well in 1990, and in the service stocks, I particularly like Baker Hughes and Halliburton.
Why will the price of oil go up, and where will it go to?
It'll go up because we've had enough down, and companies have learned how to operate in lean times, and I think that you'll see a 20% increase in the price of oil this year.
In any event, gentlemen, whatever happens to the markets, let's make sure that 1990 turns out to be a very good year for our viewers. Carter Randall, a number of viewers have sent me questions about the U.S. national debt. So for the benefit of Lyle Anderson of Warrenton, Oregon, Andrew Mason of South Weymouth, Massachusetts, and some others, would you tell us, 1, to whom does the government owe this money? 2, when was the last time the U.S. government had paid all its debts and was in surplus? 3, how serious is this problem? How is it affecting our economy and our financial markets?
Wow. Well, Lou, first of all, the debt is owed to a lot of investors, individuals, pension funds, banks, insurance companies, foreign investors. And not to be overlooked is our own Social Security system, which is one of the biggest investors in U.S. Treasury bonds. The last time we had a surplus in the budget was 1969. Last time we had 3 years straight was 47, 8, and 9. Incidentally, both of those were precursors of economic downturns. And the last time we had no debt, you got to go back to early 19th century on that one, and I don't know the year, but it's obsolete. As far as the economy is concerned, it affects it dramatically because debt creates inflation and high interest rates, but it also stimulates growth in the economy.
All righty, John Dessau, 2 questions about possible investment opportunities being created by these changes in East Europe. Mary Capagoda of Edmonton, Canada, wonders whether you have any recommendations in the areas of banking and telecommunications in these countries. And Bo Dolph of Unadilla, Georgia, is looking for West German construction firms that might be involved in the modernizing of East Germany's infrastructure.
Good ideas, all 3. The banks in Europe are also brokers, so I don't think you have to go into a bank that is particularly tied with East Germany, and my choice on a price basis would be a bank called AMRO, A-M-R-O, or the Amsterdam Rotterdam Bank. There are ADRs, or American Depository Receipts, traded here in this country. The price of those ADRs is about 42 or 43 at the moment. Telecommunications, the way I'd like to play that is to recognize that all of the telephone systems of Eastern Europe are in need of a lot of new equipment, and a company that's sure to profit from that is a German company called Siemens. And again, there are ADRs available, and they trade for about $88 to $90. The construction and engineering firm that I like in Germany, and one I'm sure will benefit from what goes on in particularly East Germany in the new year, is a company called Mannesmann, M-A-N-N-E-S-M-A-N-N. ADRs available, a little more expensive, about $200 US a piece.
I see. As usual, no guarantees in any language. Pete Calhoun, how would you respond to Colleen Colby of Mount Vernon, Iowa? who writes me as follows. In view of the growing national concern about our country's brimming garbage dumps, I believe that disposable diapers will become outlawed soon, or at least socially unacceptable. I would like to buy stock in companies manufacturing either biodegradable disposable diapers or cloth diapers. Can you suggest any such companies?
Well, Ms. Koba is right in that we got a big problem with disposable diapers. We have about 30 billion a year, and they're so waterproof to the wearer that they'll be in our dumps for a long time. But there's hope on the way. Archer Daniels Midland has developed a cornstarch ingredient that will make the waterproof layer biodegradable, and I think ADM, Archer Daniels Midland, is an interesting stock for that reason. I don't know a play on the cloth diapers because people really like the disposable. So the bottom line here, Lou, and it's not degrading, is that Huggies are going to be pampered and made biodegradable.
Thank you very much, Pete. Now, if you would like to wipe the slate clean, get to the bottom of things, our panelists are always cut from a different cloth. So to pin them down and really clean up, just drop your money questions into our crib here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. That's just a little dry humor, folks. And for some other thoughts on what to do till the financial doctor comes, let's go right over and meet tonight's special guest, Peter Lynch. Peter, welcome. Always a joy to have you.
Great to see you.
Please have a seat. When Peter Lynch first appeared as my guest on this program in 1982, his Fidelity Magellan Fund had about $350 million for him to invest. Today it has about $12.5 billion, or considerably more than the entire gross national product of Guatemala. Well, you talk about a television program with an affluent audience. But while his 5 appearances here may not have hurt, much more to the point was that Mr. Lynch just kept on producing, making Fidelity Magellan not just the largest, but the single best-performing mutual fund of the entire decade, with a gain of more than 1,100%. Peter, what are you going to do for an encore in the 90s?
Well, I hope, I've said this earlier, my goal over a long period of time, not every year, would be to beat the market by 4 or 5%. I think that's a real fair objective. If I can do it, I'd be very happy. I think that would be an accomplishment for my shareholders.
You've told us over the years not to expect much from you, that your fund was getting too big, but
right.
you keep on performing well. What are you doing differently? Why isn't everybody doing as well as you are?
Well, I think a lot of people spend so much time predicting the big picture, what the economy is going to do, what interest rates are going to do. I mean, Alan Greenspan heads the Federal Reserve. He doesn't know what's going to happen in interest rates. How the heck am I supposed to know what's going to happen in interest rates? So they spend too much time on that. I think if you look at 10 companies, you're going to find one that's interesting. If you look at 20, you'll find 2. I mean, I looked at General Public Utilities after it doubled. And I got a triple out of it. I've looked at companies with unions. I've looked at companies that are in, very dead industries. So I think people have to be too focused. They'll just say, I only want to look at rapid growth fields. I think that's a big mistake.
What do you think of some of the other common mistakes small investors make?
Well, and one thing they do is they don't understand what they own. And they also play the market. That single term, play the market, has done more damage. I think we've had this great 8-year bull market and people have lost money. It's obvious they got into the market, they bought options, they got out. You own a company. You don't own a lottery ticket. If the company does well, like Walmart or Limited, you can do very well. You don't have to buy it the first day. You could have bought Limited after it had 50 stores opening. You could have bought Limited after it had 100 stores open. You have plenty of time to do a little bit of work. It's not that hard. People are very careful with their money. When they buy a refrigerator, they do some work. When they buy an apartment or they rent an apartment, they're careful. For some reason, when it comes to stocks, they just go cuckoo. They don't do any work at all.
You have exemplified the patience you preach. You've said yourself that your big winners tend to come the 2nd, 3rd, 4th year you own them, not the first
right.
week or the first
right.
month. Where do you, as a patient investor, look now?
Well, I think the great values today are more in the obscure, the secondary companies. Companies such as Bergen Brunswick, Circuit City, Collins Foods, Henley Group, Hudson Bay Company, companies like Nurco. I mean, those kind of companies, Sims, Stewart & Stevenson, United Technologies, U.S. Shoe looks attractive, Verity. I have about 25 more. I'm afraid we'll run over to Masterpiece Theater. But I mean, it's more of the obscure companies that it's not the mainstream of companies have done very well. They need a rest.
You were ahead of the market last year in one respect in that you always have avoided technology companies because you say you don't understand what they do.
Right.
Are these all companies where you understand what they do?
I have a very good idea, yes. I have a very good idea what they company. U.S. Shoe I can understand. They've come up with finally a comfortable shoe for women. Carolyn thinks this thing's going to work. Easy Spirit, she's tried it, it's comfortable, and they have a turnaround lens crafters. I can understand these companies. I do get caught up in technology. Normally near the high, I finally wind up and give up and buy them. And yet now some of the technology stocks are actually cyclicals, and there's a chance in companies like Intel. There's chances in companies like a turnaround could occur in companies like Control Data or IBM. So I'm looking at those as special situations today.
Peter, before I turn you over the panel, I want to ask you one other question about your own performance, which has been so spectacular, but I think it would be instructive to people. How often have you had big declines in your fund in the past decade?
Okay. Well, I've had, in the 12 years I've run the fund, 8 times the fund has declined 10 to 30%, which is about equal to the stock market. In the last 70 years, the market has had 40 declines of 10%. 13 of those have averaged about 33%, big ones. And you know, that I don't think we're having one like that coming. I think it's very possible. People have to say, what's the likelihood the market's going to go down in 10, 15%? What am I going to do in a year when that happens? Am I going to buy more shares? Am I going to add to my fund? If they're going to retire in a year, if they have to send their child to college in a year, they should be in the bank now. They should be in a money market fund. These stocks are very random over 12 months. And that's a big mistake. If you buy a 3-month option, you discover that fast.
Let's go to a 3-panelist option, starting with Carter Randall.
Peter, your fund is highly diversified either because you want it that way or it has to be that way. Right. How diversified should an individual be?
Well, I think a person should only follow 5 or 6 companies. Some companies they know something about. They work in the chemical industry, they work in the insurance industry, they supply those industries. They have a big edge over me. They see those turn way the heck ahead of me. Or it's some local company they know something about. So I think they should follow 5 or 6 companies and maybe own 1 or 2. You only need 1 or 2 good stocks a decade. You don't need a lot of action. People are so confused in that element. All you make, when you put $1,000 in a stock, all you can lose is 1,000. I've proved that a lot of times. But you can make 10,000, you can make 15,000. Right. You have to be patient. It doesn't happen the first hour. For some reason, Eric can understand it. You lose money fast in the stock market. You can't make it fast. So persons, they should know what they own. That's a huge error. If they can't explain it to a 5th grader in 1 minute or less, if their reason they own a stock is, this sucker's going to go up, they're off to a rough start. There should be a real rational reason. They should be watching about 5 or 6 stocks.
Okay. Peter, we seem to have a meltdown theory for everything every few years, and the latest big meltdown theory and excuse for not owning stocks is because of real estate. We're both from New England, and we know that there's at least a little bit of truth to the fear. Right. What would you say to people who are suffering from that anxiety?
Okay. There's only been one major downturn since World War II in average housing. This occurred in Texas, Oklahoma, Louisiana. People moved there with their family for a job in the oil boom. They moved to Alaska. They put 5% down in a house. The job went away. They left. They had no ties. They didn't have grandchildren there. They didn't have nephews. They didn't have sisters. They left. They mailed in the keys. Today, we have some very difficult commercial real estate markets, such in Arizona. But right now, residential mortgages are doing fine in Arizona. People move to Arizona for a certain reason. They're still there. 1,000 people a day are moving into California. So I still really like companies that are in this business, companies like Fannie Mae, companies like Freddie Mac, Beneficial Corp, Primerica, Golden West Financial. The average mortgage is only $80,000 for these people. They have 65% loan to value. These are very strong positions. The average house rose 4% so far this year. It's $90,000. Apartment rentals are up 2% this year. We're not having a wipeout in basic housing.
You mean last year, don't you, Peter?
Oh, that's right. What year are we in? This is 1990. I never can handle that. So there isn't a disaster coming on. There's 2.5 million people working than a year ago.
Peter, there are a lot of very bright people in the investment business that would like to have a record as good as yours. And they have resources similar to yours, chart rooms, analysts, statisticians, so on. What do you think when you look at yourself personally is the skill that you have that differentiates you from all the other people that are maybe just as bright, trying just as hard?
Okay, I'm very lucky. I work at Fidelity. We don't have any economists. We don't predict the stock market. We just have about 25 or 30 very hard-working people. We'll look at anything. We'll look at companies in bankruptcy. I bought them before they went in bankruptcy. That wasn't so great. But we look at everything. We're very flexible. And it's just a great company. And I think we buy companies that have all sorts of problems. Some firms are so narrow. They won't buy companies that start with the letter R. They say those managers are a bunch of jerks. We really emphasize company research. And I think that's been the difference. Trying to predict the big picture is so difficult.
Peter, we're nearly out of time. You usually describe yourself as fully invested and not a market timer, but you have about 11% in cash, and that's supposed to be the highest ever for you. What does that mean?
Well, I've been buying stocks every single day the last 3 months. For the first time in a long time, money has started to come into my fund. And I have not been able to find the stocks I want, so I'm just going to let it build up, put the money to work. I bought stocks today. I'm going to buy stocks on Monday. But right, I don't expect a big decline because the public has not been, like in 1987, 83, the public came in very big. Foreign buying was extremely big. We have none of those elements today.
Thanks very much, Peter Lynch. Your confidence is always unfashionable, but it seems to work out over the years. Thanks again to our panelists. Hope you'll be back with us next week. Not once, but twice next week. First, join me Tuesday at 10 p.m. Eastern Time in most cities. Check your local listings for a 1-hour PBS special, Louis Rukeyser's 1990 Money Guide, with an array of guests from Henry Kissinger on how the rapidly changing world will affect your pocketbook, to a big city mayor with a unique solution to the drug problem, to investment whizzes of every stripe. It'll be a guide designed for you. And then join me as usual next Friday night when we'll light up the sky with a program about utilities. My guest, Ann Prevenson, is an expert on the industry that not only provides America's power, but has lately been one of the most powerful performers in the stock market. So don't forget to switch us on twice next week. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Happy New Year again, and good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you. By The Travelers, the company that helps provide financial peace of mind for American business. And by Prudential Bache Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.